All right, let's jump right in. Today, we're going to break down a systematic option strategy called the WiFly. Now, its creators make a pretty bold claim that it's a data-driven path to growth. So, you know what we're going to do? We're going to unpack the numbers and see what's really going on here.
And this is the number that gets everyone's attention. $8.5 million. It's a jaw-dropper of a figure, for sure. So let's figure out how a system could possibly generate a projection like this.
And that's really the core question, isn't it? How on earth could $25,000 turn into, well, that in just 5 years? The whole premise here is that it's not some kind of magic, but a very specific, repeatable process that's all driven by data.
So first things first, let's dig into the foundation of that big promise. Where does all this confidence actually come from?
And this is really the key. We're not just talking about some idea someone cooked up. The entire projection is built on the back of over 300 actual trades, a solid mix of historical backtesting and, importantly, real money, live trading. That data is the bedrock for everything else we're about to talk about.
Okay, so to understand how WiFly works, we have to pop the hood and look at the engine. At its core, it's a specific option setup known as the iron butterfly.
At its heart, an iron butterfly is basically a bet on boredom. Seriously, it's a neutral strategy, which means you don't have to be a genius and guess if the market's going up or down. You're just trying to make money if the market, well, chills out and stays in a range. You let the clock do the work through something called time decay. It's like an option's value is a melting ice cube, losing a little bit every single day.
And putting one together is actually surprisingly simple. You sell a call and a put right at the current market price. That's what generates your income. Then, and this is crucial for managing risk, you buy a protective call and a protective put further out. These act like insurance. All this creates a nice defined profit zone, and the goal is just for the price to hang out right there in the middle between those protective wings.
But here's the thing. Plenty of people treat iron butterflies. The secret sauce here isn't just the structure itself, it's the very specific, rigid set of rules they applied to it. This is what they call the WiFly proprietary edge.
This edge really stands on 3 distinct pillars: a very specific entry time that's backed by data, a unique filter they use to weed out bad trades, and a super disciplined approach to risk management, which is absolutely essential for survival and growth.
So the first edge is all about timing. Every single trade is entered at exactly 1:30 p.m. Eastern. Now, why so specific? Well, third-party data from Options Alpha actually confirmed this is a kind of sweet spot. You dodge all the crazy morning volatility, and you've positioned the trade perfectly to capture a full 26.5 hours of that sweet, sweet time decay before it expires the next day.
The second edge is a filter. The system will only take a trade if a momentum indicator called the RSI is above 58. According to their data, just adding this one single rule took the win rate from basically a coin flip at 50% all the way up to a much healthier 67.6%. That's a huge jump.
And the final piece of the edge. Honestly, this might be the most important one. It's all about protecting your money. Yeah, each trade ties up about $2,200 in buying power, but the strategy's exit rules are designed to cut losses at just $900 per contract. That defined risk is absolutely critical for letting the compounding do its work over the long haul.
So we have a strategy with a clear statistical edge. But how does that turn into the explosive growth we saw at the very beginning? That, my friends, is where the compound growth engine comes into play. The growth is powered by a dead simple formula that takes emotion completely out of the equation. Your position size is just 15% of your account value divided by that max risk of $900. What this means is, as your account grows, your trade size grows right along with it, automatically. It's that snowball effect, but on steroids.
And just look at the power of that formula in the first year alone. A $25,000 account starts out trading just 4 contracts. But, based on the model's performance, by the 12th month, that same account is now trading 24 contracts. It's the exact same strategy, the same edge, but the scale is 6 times bigger.
Okay, now projections are one thing. They're exciting, but it's absolutely crucial we ground all of this in historical performance and talk very clearly about the risks involved. So let's look at the real numbers.
And what's really compelling here is how consistent the live trading results are when you compare them to the backtest. I mean, look at this. The 37 live trades actually showed a slightly higher win rate and a better Sharpe ratio, which is just a fancy way of measuring your return versus your risk. And the max drawdown, the biggest dip the account took from a high point, was also really similar, right around 15%.
This chart really visualizes the strategy's edge perfectly. On average, a winning trade made about $531. An average losing trade lost about $465. The big takeaway here is that you don't have to be right 100% of the time. The whole game is about having a positive mathematical edge where your wins are bigger than your losses. That can play out over hundreds and hundreds of trades.
Okay, now it's time for a major reality check. And I want to be absolutely crystal clear about this stuff. This is not a get-rich-quick scheme. All trading, especially with options, involves a substantial risk of loss. You have to be okay with weathering drawdowns, like that 15.6% drop from a peak. And maybe the hardest part for most people, this is a game of patience. Because of that special filter, the system only finds a trade maybe 7 or 8 days a month. You have to have the discipline to sit on your hands and do nothing when the conditions aren't perfect.
So, to wrap it all up, the data points to a proven edge. The math for compounding is straightforward, and the performance history is transparent. The system itself is just a set of rules on a computer. The final, and by far the most important variable in all of this, is the human element. So the real question this leaves us with isn't whether the system works, it's whether a trader can actually execute it with perfect, unemotional discipline, day in and day out over the long run.